Hi guys, let's start our discussion on profit and gains from business or profession. This is very important topic. The first question in your question paper you will see is from this topic only. This is the backbone of CA inter income tax boss. Are you getting it? Now, whenever you are under this topic, only one thing will keep in your mind. We have to compute profit boss. That profit which has to be offered under the PGBP head. See, profit is nothing but income minus expenditure. Yes or no? Profit means income minus expenditure. Now, what we will learn on this in this topic is what are those incomes which I have to offer to tax? What are those expenses which I can claim it as a deduction? Section 28, Section 41 will tell you which are those incomes you have to offer to tax. Section 30 to Section 37 will tell you those expenses which you can claim as deduction. Section 40 to 43B will tell you which are those expenses which are disallowed. You cannot claim those as expenses. Is it clear till now? So let's get into the topic and check what are those incomes, expenses, disallowances, allowances and all. The first section is Section 28. So Section 28 has a list boss. In this list, you will see all those kind of income which you have to offer to tax under the head PGBP. First income is interest, salary, bonus, commission, remuneration by whatever name called earned by a partner from a partnership firm. You will be very confused. Sir, interest is taxable under IFOS. Salary is taxable under income from salary. Bonus, commission, what is this, sir? Boss, partner is not an employee of a partnership firm. First thing, he is a part owner of the partnership firm. That is why whatever payments he will receive from that partnership firm means he is doing business and he is getting remuneration. He is getting that salary, interest, no, yes or no. That is why those payments are taxable in the hands of partner under PGBP head only. Next, income from letting out of commercial property. Because there are two concepts. One, if you are into business of letting out of commercial property. Two, in the business of letting out of a residential house property. If you are in the business of letting out of commercial properties, that rental income whatever you receive is taxable under the head PGBP, whereas rental income received by doing business of letting out of residential house properties will be taxed under the head income from house property. Be very mindful. Some received for not carrying out any activity. What is this, sir? Let's say, for example, Mukesh Ambani is already a conglomerate or a monopoly in a geo telecom industry. Yes or no? Let's say, for example, Anil Ambani wants to get into telecom industry, wants to launch his own brand. Now, Mukesh Ambani will stop him. Because I am already a monopoly in this, big giant in this. You cannot enter this business. Then Anil Ambani will say, boss, give me some money so that I'll keep quiet. So whatever money or compensation Anil Ambani will receive from Mukesh Ambani will be taxed under the head PGBP. Not sharing any know-how, patent, copyright. You know this company Bharat Biotech which created a vaccine formula during COVID. Yes or no? Let's say for example China approached Bharat Biotech to share this formula with them. But Modi government told to Bharat Biotech, they sell to any country, but don't sell to China. Then Bharat Biotech will tell, sir, I'm losing revenue, sir. Who will compensate for that? Then Modi government will tell, I'll give you some amount. Don't worry. That amount, whatever Bharat Biotech will receive from Modi government, will be taxable under the head PGBP for not sharing any know-how, any patent. If assessee is engaged in business of letting out of residential houses, just now we discussed compensation for termination of any contract. Let's say for example under contractor the other party told you or promised you that he will do something but he didn't do, so he has to compensate, that compensation you received, that will be taxable under the head PGBP. And any professionals carrying a specific, let's say for example there is a group or association of chartered accountants, and that chartered accountants, from those chartered accountants, that group collects money so that they can provide training to these chartered accountants, that will be taxable under the head PGBP. Import entitlement license. There is one license which you have to take in order to import goods from outside country. Let's say for example this year I don't have business, only there is no demand only for the product. Why should I import? Then I have the license. What should I do with this? There is other person who needs the the import license so that he can import some goods. So I can sell this import entitlement license to someone and he can import goods. So whatever amount I will receive from him for selling the import entitlement license will be taxable under the head PGBP. Next, Keyman Insurance Policy. See, recently Mr. Legendary Ratan Tata died. Yes or no? So, the business of Tata would have generally got affected. No. So, what happens? This Tata company would have already taken a Keyman Insurance Policy for Mr. Ratan Tata. Means if Mr. Ratan Tata dies, the whatever business got impacted, that they can get compensated by way of compensation received from Keyman Insurance Policy. So whatever amount they receive from KMP will be taxed under the head PGBP. So whenever you convert a stock in trade into capital asset, whenever you convert a stock in trade into capital asset, in that case, the fair market value as on the date of conversion of the inventory or the stock in trade will be treated as a PGBP. Duty drawback on exports. Let's say, for example, if you export something, the government will become very happy that you are earning a lot of forex reserves for the country. So they will give you some duty drawbacks. All those will be taxable under the head PGBP. If you transfer any asset which you have already claimed a deduction under section 35 AD, then that asset, whatever amount you receive on the transfer, that will be taxed under the head PGBP. Duty entitlement passbook scheme, if you transfer that, on that, if you receive any profit, even that is taxable under the PGBP Act. So whatever we have seen under section 28, if you see these kind of incomes in your question paper, immediately tax it, tax it, tax it. Next comes a concept called as speculation business. Sir, what is speculation business? Simple, boss. If you trade in commodities or shares, if you purchase, sell commodities or shares, but without taking the actual delivery of these two products, commodities or shares, that is called as speculation business. And you have to compute speculation, you have to treat a speculation business as a separate, because loss of a speculation business can only be set off with the profit of a speculation business. Next, so just now we spoke when the introduction, at the time of introduction itself, I told you profit is nothing but income minus expenditures. So we will now look at what are those expenses which I can reduce from my income. So the first expenditure is given under section 30, rent, rates, taxes, repairs and insurance for building. So if you pay rent, if you do some part of revenue repairs, capital repairs are not eligible for deduction, mind you. So any taxes you have paid for the building, like municipal taxes, or if you paid any insurance, those you can claim as expenditure against the income. Next, section 31, repairs and insurance of plant and machinery and furniture. For plant and machinery and furniture, if you have expended some revenue expenditure for repairs and any insurance premium you paid, that you can claim. Sir, why rent is not allowed here? Rent is allowed under section 37. Next concept is very important, depreciation. We will go very slow here, boss. Very important. There is a twist and tweaks here, so we have to understand in a beautiful manner. See, depreciation. What is depreciation? Depreciation is nothing but reduction in the value of asset. Yes or no? You have to reduce it. Correct? In order to claim depreciation, you have to satisfy two important conditions, boss. Condition number one, you should use that asset. Put to use the asset. Put to use the asset. First condition. Second condition, you should be owner of the asset. Put to use means just you got machinery, you did not use it, just it is a idle. Then you cannot claim depreciation. Only from the day you will start using the machinery, you are eligible for depreciation. And you should be owner of the asset. So two conditions you have to satisfy. There are some other points which you need to keep in mind. What are those other points, sir? See, first point is depreciation is mandatory, boss. It is not optional. You have to mandatorily claim depreciation. Next, if you have used the asset for less than 180 days, only half of the depreciation, half of the rate of depreciation, you are eligible to claim. But this condition is applicable only if you put to use the asset in the first year itself. Let's say, for example, you purchased a machinery in the previous year, 22-23, you purchased a machinery. You purchased a machinery in the previous year, 22-23. but you did not start using this machinery. You started using the machinery in previous year 23-24, for example. So in 23-24, even if you use in this year, in the next year, even if you use the asset for less than 180 days, still you will claim full depreciation. But whereas in this case, if I started using the asset in previous year 22-23 itself, and I used the asset for less than 180 days, in that case, half rate depreciation will apply. So if I put to use the asset in the first year in which I purchased, in that year, if I used for less than 180 days, half rate. In the first year, I used the asset for more than 180 days, full rate of depreciation. In the next year, if I started using, even though I use it less than 180, even though I use it for more than 180, still I can claim full amount of depreciation. And the depreciation will be available only for the owner of asset. Means the tenant cannot claim depreciation. Now, if assessee runs business in a rented building, let's say for example, I am doing business and I have rented a property. Can I claim depreciation? No, because depreciation can be claimed by whom only owner of the asset can claim depreciation. But I am a tenant here, boss. I'm running business in a building which I have taken on rent. In that case, let's say for example, I did some capital repairs to the building. Then in that case, that part of capital expenditure which I spent in order to repair the building, that for that part I can deemed be as a owner and I can claim depreciation. If I am a tenant, I have done some capital expenditure repairs to that building. In that case, I can claim depreciation being a deemed owner of that capital repairs. If I am part owner, let's say for example, the property is owned by multiple owners, in that case, to the portion of my ownership, I can claim depreciation. In the case of lease, only the lesser means whom? The owner who has given on a lease to someone, that lesser only can claim depreciation. In the case of hire purchase, you must be knowing in your accounts you would have read. Hire purchase means the person who is purchasing the asset makes the payment in installment. Last installment he will get ownership and all. So in hire purchase, even though he is purchased the asset on hire purchase, still he can claim depreciation. No need to wait for the last year. Now there are two methods to compute depreciation, boss. SLM method, WDV method, generally straight line method, and the WDV method, written down value method. What happens in straight line method? You calculate the depreciation on the actual cost. What happens on the WDV method? You calculate depreciation on the reduced balance, the opening balance of the opening WDV of the asset. On that you calculate depreciation. See, under Income Tax Act, SLM method option is available only in the case of power generation, power distribution companies. It is not available for other assessees. Only if you are in the business of power generation or distribution of power, only in that case you are eligible. You have the option whether to opt for SLM method or WDV method. In all other assessees, it is mandatory to compute the depreciation under WDV method. But generally under Income Tax Act, the method used is WDV method only. But the depreciation system is called block of asset system. What is block of asset system? Very simple, boss. Assets with the same class, same rate. Same class means what? Furniture is a class of asset. Building is a class of asset. Plant and machinery is a class of asset. So these are different classes. Again, in the you have to see the same rate of depreciation. So whatever assets are having same rate and same class, you will create a block of that. But you will compute the depreciation under the WDV method only. So you, for creating the block, you will see same class, same rate of depreciation, and then you will create block. But the method you will use for calculating the depreciation will be WDV method only. Next. So just now I told you there are different classes of assets. So there are 4 classes. And where the depreciation rates are given, sir, in this table, all the depreciation rates are given. You have to definitely look at this table and understand, and few you have to definitely memorize. You have to memorize, boss. Sometimes they give an examination, sometimes they don't. So in that case, it is very helpful. Now there are some important points. See, in intangible assets, generally, till recently, very recently, goodwill on business and profession was eligible for depreciation. But very recently, they have removed goodwill and depreciation, goodwill of a business and profession for the purpose of depreciation. So now you cannot claim depreciation on goodwill of a business or profession. Mobile phone is not a computer, boss, so you cannot claim a 40% rate of depreciation. Depreciation when only actual put to use. I told you already this. Land is not eligible for depreciation. Building also includes roads, bridges, everything. Plant does not include tea bushes and livestock. Books, vehicles, scientific apparatus and all comes under plant definition only. Now, this is very, 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 very important. How do you compute depreciation under the block of asset system method? See, boss, take first the see. I am whatever I am discussing. This I am not discussing from an individual asset standpoint. I am discussing this from the standpoint of a block. What I told, what is a block? Block is nothing but it will have all those assets of the same class with the same rate. Yes or no? First, you will take in order to compute the depreciation calculation of depreciation under block of asset method. First, take opening WDV of all the assets which are there in the block. Opening WDV. To that you will add. Naturally think, boss, opening at the start of the year you had opening WDV. Then you purchased a few assets, no? Yes or no? So add value of purchases made during the year in this block. So whatever value you will get, out of that what you will reduce? The sale value. In technical it is called a money payable. Money payable is nothing but it looks like money payable. It is not payable, actually receivable. So sale value of all those assets which you sold during the year. So technically think, boss, opening WDV, add purchases means whatever you have in hand, less sale value. What you should technically get? What you should technically get? Closing WDV. But that WDV you will use for what? Depreciation purpose. So opening WDV, add purchase value, less sale value will give you what? WDV for the purpose of depreciation. On that value you will compute what? Depreciation. And once you reduce the depreciation from that, what you get is closing WDV for the year. So opening WDV, add actual cost of assets acquired during the year, less money payable. WDV of assets transferred, that slum sale we will discuss separately. WDV of block for the purpose of depreciation, less depreciation actually allowed, and closing WDV you will get. Sir, what is this in a green, sir? Shall never be negative. What do you mean, sir? Very simple, boss. Let me take one beautiful example here. Let's say, for example, opening WDV of the block was 20,000 rupees. You purchased for 10,000 here assets. Total how much da? 30,000. Opening WDV of the block was 20,000. You purchased assets worth 10,000 during the year. So 30,000 is the total. Let's say, for example, you sold few assets during the year for 42,000. What is the amount you will get if you reduce this 42,000? Negative 12,000 you will get. Negative 12,000 you will get. But can you tell me the next step after reducing this 42,000, whatever 12,000 I got, what is it representing? This 12,000 represents a WDV of the block for the purpose of depreciation. Yes or no? This represents this negative 12,000 represents WDV for the purpose of depreciation. Yes or no? Can you claim depreciation on a negative value? Can you claim depreciation on a negative value? Not possible, boss. That is why this dialogue is given here. Shall never be negative. Then what do we do, sir? Very simple, boss. You can maximum reduce 30,000 here. You can maximum reduce 30,000 here. So the block will become zero. But sir, how can a block become zero, sir? There are few assets. There may be few assets pending. No. Let's say for example, sir. Here 20,000 means 5 assets are there, sir. I purchased 2 more assets and I sold only 4 assets. There are still assets pending in the block, sir. Then how can assets are existing and the block becomes zero? Yes, it is possible. Let's take one table and try to understand this whole Thandavam here. This table is very beautiful table, boss. This will summarize your whole depreciation tweak twist concepts. Let's take the first column, first column. Imagine you have 10 assets in the opening WDV. Total number of assets in opening WDV, you have 10 assets. Okay. Add number of assets purchased during the year. 4 assets you purchased. So how many assets you have? 14. 14. Let's say for example total number of assets sold during the year is 8. So out of 14 assets, if you sold 8 assets, how many assets are still pending? 6 assets are there in your hand. Yes or no? Yes or no? Yes or no? Now if the sale value is more than opening WDV plus purchase, is the sale value more than opening WDV plus purchase, means the upper value, is it less than the lesser value, is a lower value? In this table wherever we discussed this, if this money payable is more than these two, automatically it will become negative, noda? Yes or no? Just now we have seen this example. So that scenario exactly we are discussing here. So we have 6 assets on hand and my sale value by mistake increased more than the purchase value and the opening WDV. In that case, my block will become nil but never negative, because on that negative you cannot claim depreciation. So one star mark I have given here. What is the star mark? Block can be nil but never be negative. STCG shall also arise in this case. Sir, STCG, how sir? Because boss, in this case if you see 42,000 was the sale value, but what was that value you sold for? See, 30,000 worth of assets, 30,000 worth of assets you sold for 42,000, means there is a gain. There is a gain. This 42,000 is what? Sale value, boss. What you sold, 30,000 worth of assets you sold for 42,000, that 12,000 will become your short term capital gain. Got it? Next. Second column. Total number of assets 10, purchased 4, total will be 14, sold 8 assets. In still the same scenario, 6 assets you have on a hand still, but is sale value more than opening WDV plus purchase? No. Means in this example, let's say for example in the place of 42,000, if I remove this 42,000, I will just write 22,000 for example. If I write only 22,000 for example, then 30,000 minus 22,000 will, I'll get positive result. I will get a positive result. No, 8,000. Then on that 8,000, can I claim depreciation or not? Can I claim depreciation on that 8,000 or not? Yes, of course I can claim. So that will be called as the balance of the block. On that I'll claim depreciation. The rest will become my closing WDV. That is what is given here. If sale value more than opening WDV plus purchase? No. If the sale value is not, then the balance you will see, depreciation shall be computed on the balance amount in a block. I hope that is clear. Now we will look at a scenario where assets, all assets you sold off. In first scenario, what we saw, few assets only you sold. 1 plus 4, 14, minus 8, only 6 assets were still there in the block. But now in this scenario, all the 14 assets if I sell, what should be the adjustment? Let's say for example in the third scenario, 10 assets you had in hand during opening, 4 you purchased, totally 14 you had, and sale, total number of assets sold is 14. You sold all the 14 assets, boss. Then what will happen? Then the block ceases to exist. Yes or no? Yes or no? Now, is the sale value more than opening WDV? Yes or no? Yes. If the sale value is more than the purchase value on the opening W, straight away you will get what? The short term capital gain. If the sale value is less than the opening WDV and purchase value, what you get? Loss, short term capital loss. I hope that is absolutely crystal clear, boss. Now, there are some important points which you need to discuss. If the asset acquired but not put to use, you are not eligible for depreciation. Actual sale price shall be reduced, not the FMV of the asset. What happens? No, a lot of times, let's say for example, the sale value what you are offering is less than the fair market value or the stamp duty value in the case of building. In that case, for the purpose of PGBP or capital gain, you take FMV or SDV. But for the purpose of depreciation, you will only take what? The actual sale value to reduce from the block. Money payable means a sale price. Condition of half rate of depreciation applies only in the year of purchase. This we have already discussed. Next, additional depreciation. Whatever we discussed on the section 32(1) is only the normal depreciation. Now there is a concept called as the additional depreciation. What is the concept called? Additional depreciation. What is additional depreciation? In order to, in addition to normal depreciation, you get something called as additional depreciation. There are few conditions to be met. Only then you will get this additional benefit. This additional benefit is under section 32(1)(2)(a), it is given. But mind you, this additional depreciation is not available if you opt for default tax regime. Under default tax regime, you are not eligible for under default tax regime you are not eligible for additional depreciation. It is only available if you follow optional tax regime. Now in order to claim additional depreciation, only on one asset is it is available, which is plant and machinery. Additional depreciation is available only on plant and machinery, and that too it should be a new plant and machinery. New plant and machinery, that too you should use the plant and machinery in a manufacturing business only. So first condition, you are not eligible for additional depreciation under default tax regime. Number two, it should be a new plant and machinery only. Number three, the assessee should be in the business of a manufacturing only. In these cases, if you satisfy, you are eligible for additional depreciation of 20% apart from the normal depreciation what you get on that machinery. Is it clear? Now the same condition which I discussed, that if you put to use the asset in the first year for less than 180 days, then you will get half rate of depreciation. The same ditto concept, that if you use the asset next year, that and all. So same concept, if you use the asset for less than 180 days in the first year, in that case only half of the additional depreciation you will claim. Means only 10% you will be eligible to, the rest 10% you can claim in the next year. So conditions: new plant and machinery, business of manufacture. One more thing, even if you are in the business of manufacturing, generation and distribution of power, still you are eligible for the additional depreciation. Must opt for optional tax regime, means it is not available under default tax regime. Additional depreciation is allowed only if a WDV method is followed. This is also important point, boss. WDV method, if you follow SLM method, you cannot claim additional depreciation. Only if the assessee follows WDV method, only then you will be eligible to claim a additional depreciation. What is the rate, sir? 20%. Less than 180 days, half rate, which is 10%. Next, the remaining additional depreciation can be claimed in the next year if the assessee still pays tax under optional tax regime. Very beautiful point, boss. Let's say, for example, in the first year in which you purchased the asset, you are under optional tax regime. So you claimed a depreciation of more than 20%. I mean, sorry, in the first year in which you purchased the new plant and machinery, you are paying the tax under optional tax regime. Okay, but you used the asset for less than 180 days. In that case, you will claim only half, which is 10%. What I told, the rest 10% you can claim in the next year. But in the next year, you can claim that rest 10% only if you are still under optional tax regime. Let's say, for example, you have shifted out of the optional tax regime, and you started paying taxes under the default tax regime, for example, in the next year. Then you are not eligible to claim that additional depreciation which is left of now 10%. In that case, what you will do is, that additional depreciation which you could not claim, you will add it to the block of asset. You will add it to the opening WDV of the block of asset in the next year. Now, plant and machinery not qualifying for additional depreciation. What are those plant and machineries which is not eligible for additional depreciation? Second hand machinery you cannot claim, boss. I told you already, new plant and machinery should be there. If you are using the plant and machinery in office premises, residential accommodation, you cannot claim. If those are office appliances, road means, boss, simple. Use the plant and machinery for manufacturing purpose, you are eligible. That's all. If your asset is already has claimed deduction under section 35AD, you cannot claim additional depreciation. Business of printing is also eligible for it is also treated as a manufacturing business. You can also claim depreciation, additional depreciation on that. Now, there are two concepts, boss: terminal depreciation and balancing charge. These two concepts are applicable or eligible only in the case of power generation and distribution units if they follow SLM method. I repeat, this terminal depreciation concept and balancing charge concept is applicable only in the case of power generation and power distribution units if they follow SLM method. SLM method. Are you getting this? If they follow WDA method, then this is not applicable. What is a terminal depreciation, sir? Simple, boss. If the asset is sold for less than WDV, if the asset is sold for less than WDV, then whatever the difference between the WDV and the sale price will be treated as terminal depreciation. Example, sir. See, let's say for example, you purchased the asset for 1 lakh. The WDV as per the SLM method, it is 80,000. Means as on today the value of the asset is 80,000, but you sold the asset for only 58,000, boss. Then you sold the asset for less value or high value? Less value, no. 80,000 worth of asset, you sold it just for 58,000. Then there is a loss. How much loss? 22,000. That loss is nothing but called as terminal depreciation. Is it clear? So that is called a terminal depreciation. Is there a balancing charge? No. Is there a capital gain or loss? No. So you may be thinking, sir, this 22,000 is a loss only. No, but that itself is treated as what? Terminal depreciation. What is balancing charge, sir? In the same scenario, if you sold the asset more than WDV value, then you will get something called as balancing charge. But there is one twist here. Only to the extent of the actual cost of asset, whatever increased, whatever higher value you sold for, only that is called as a balancing charge. If you sell the asset for more than actual cost, then you will get capital gain also here. Let's see the example. Actual cost of the asset was 1 lakh. WDV was 60,000. Means actually as on today the value of the asset is how much? 60,000. You purchased for 1 lakh. Sale value is 78,000. First example, 78,000 is the sale value. Then tell me, what is the higher amount you got? 18,000 you got because 60,000 was your WDV. Sale value is 78,000. What is the higher amount you got? 18,000. Is it exceeding the actual cost of asset? Is it exceeding 1 lakh? The sale value, is it exceeding 1 lakh? No. In that case, you will not capital gain. You will not get capital gain. Only you will get what? Balancing charge. What is this balancing charge? 78,000 minus 60,000, which is 18,000. Capital gain nil. Let's say for example in example 2, you sold the asset for 1,22,000, means you sold the asset for more than actual cost. In that case you will get both balancing charge and capital gain. So to the extent of actual cost, means to the extent of 1 lakh, beyond your WDV value, whatever is there, the balance 40,000. So 1 lakh minus 60,000, 40,000 is the balancing charge, whereas 1,22,000 minus 1 lakh will be treated as a capital gain, the short term capital gain. Next, actual cost. See, why do we compute this actual cost? Without computing the actual, without knowing the actual cost, how will you add it to the block, boss? Because in the block, you remember opening WDV, add actual cost of the asset purchased during the year. That actual cost we are discussing here. There are multiple scenarios given and you have to understand which cost has to be considered. Is it clear? Okay. Now, first scenario. If the asset is used for scientific research already, then the actual cost shall be nil. If you convert the inventory into capital asset, if you convert the stock in trade into capital asset, then the fair market value as on the date of conversion will be treated as a cost of acquisition. Asset acquired by way of gift or inheritance. If you have taken some asset as a gift or inheritance, in that case, cost to previous owner minus notional depreciation. Notional depreciation is nothing but you have to assume that that asset was used. No, for that duration, it was with the previous owner. You have to compute depreciation and reduce it. Repurchase of asset. In that case, lower of WDV and repurchase price. Asset purchased and leased back. In that case, whatever WDV of the previous owner, means the lessee's WDV you will consider. If you have used the building for personal purpose, then you got into business. In that case also you will reduce a notional depreciation. Capitalization of interest. Very, very important, boss. What is capitalization of interest? Let's say for example you purchased an asset for business purpose, which you are going to add it to the block of asset. For example, In that case, let's say for example, you took a loan to purchase this asset, then you will be paying what? Interest. You will be paying what? Interest. That interest you have to capitalize until the date you start putting to use the asset. So whatever interest you paid before starting to put to use that asset will be capitalized. After putting to use that asset, whatever interest you paid will be claimed as a deduction, as an expenditure. Interest after put to use cannot capitalize. Interest before put to use you can capitalize. There are a lot of times excise duty you pay, that also if you are getting credit of that excise duty as a input tax credit, then that is not eligible. Subsidy or grant received from the government will be added to the should be reduced from the value of the asset. In case of a 3580, already you claim deduction, so it will be cost will be taken as a nil. Now, depreciation in case of composite income. You must have read in our basic concepts discussion, we had discussed about the composite income, agriculture income, the special cases of growing of tea, rubber. In that case, you remember 65% agriculture income, 35% PGBP. In that kind of a scenario, you can claim depreciation in this manner. In case of business with composite income, that is income from tea, rubber, so and so, only partial income is treated as PGBP. However, for purpose of WDV computation, depreciation under section 32 will be considered in full. Means, for the purpose of computing PGBP, partial income is there. But for the purpose of computing the WDV of the asset, full depreciation will be allowed. There is a beautiful example given here. You can read it. Now, carry forward and set off of unabsorbed depreciation. What is unabsorbed depreciation? First of all, unabsorbed depreciation means that depreciation which you could not claim in this year, you have to carry forward to the next year. Let's say, for example, additional depreciation, I told you, no, 20% is the actual additional depreciation. Let's say, for example, in this year, only half rate depreciation you could claim because you used it for less than 180 days. Then the rest 10% you will take it to the next year. No, that depreciation which you are carrying forward to the next year is called as unabsorbed depreciation. When you carry forward to the next year, how to set off that? First, in the next year, you will claim that year's current depreciation. Then whatever carried forward or the brought forward business losses are there, that you will set off with that year's profit. Third priority, you will get to set off the unabsorbed depreciation. Order of set off is current year depreciation, brought forward PGBP loss, and unabsorbed depreciation. Next, depreciation if asset used partly for personal purposes. So you used the asset for business purpose and for personal purpose also. In that case, only to the extent you used for business purpose will be eligible for depreciation. Is that clear? Next, expenditure on scientific research. Very, very, very important. Boss, scientific research. There are two kinds of scenarios. Let me explain you in a chart format first of all. Now, scientific research. See, there are two ways. One, your own research in your organization, or a donation. So, for scientific purpose, in two ways you can spend money. One, you do your own scientific research. Number two, you can give in the form of donation so that the other person can carry out the scientific research. Are you getting this? Now, in the case of own research, there are two sections, boss. In the case of own research, there are two sections. In the case of donation, there are four sections. Means section is the section 35 only. In that different subsections. Let's see what is this talking about. Number one, scientific research. Scientific research. 1 second. Yeah. Scientific research expenditure related to assessee's own business. I told you you can spend money for your own scientific research purpose. In that case, I told you there are two sub sections or clauses you can clause. Clause 1 and clause 4. 35.1.1, 35.1.4. 35.1.1 talks about revenue expenditure. 35.1.4 talks about capital expenditure. In this case also there are two things. Let's say, for example, before starting your business itself, you wanted to do some scientific research. Before starting the business itself, you wanted to do some scientific research, boss. In that case, out of revenue expenditures, only two expenditures are eligible for deduction. Which are those? Number one, salary. The other is raw material. But in salary, you have to exclude perquisites. That is not allowed. I'm talking about that expenditure which you expended, which you spent before starting the business, before commencement, maximum 3 years before. If you have spent before 4 years, you cannot claim. Within 3 years before starting or commencing the business, whatever expenditure you incurred on scientific research for your own business, then in that case, revenue expenditure, only two expenses are eligible. One is the salary expenses which you paid, and the other is the raw material expenses which you incurred. But in salary, you will not include perquisites. All other expenses are disallowed. Capital expenditure before commencement of within the 3 years before commencement you can claim, but except land. Except land, all kind of a capital expenditure you can claim as a deduction in the year in which you started your production. After commencement of business, any expense, 100% of revenue expenditure it is allowed. After commencement, any expense except land capital expenditure is allowed. Now, I told you can also donate to some other organizations. There are four subclauses. Under clause 2, notified approved scientific research association university you are donating. Full donation you can claim as a expenditure. Number 2A, approved Indian company means you are donating to approved Indian company. Approved. Very, very important. It has to be approved organization. Scientific research and development, full you can claim. Number 3, approved social science and statistical research association or college or institution, full you can claim. 2AA, IIT, National Laboratory, University for scientific research, you can claim. Now, one very, very important boss point. This deduction of the donation you cannot claim if you are under default tax regime. I repeat, only this boss. This you can claim under both. Wait a second. This you can claim under both the tax regimes. No issues. This you can claim under both the tax regimes. But this you can claim only under optional tax regime. Means if you donate, you are not eligible for scientific research donation related expenses under the default tax regime. Is it clear? Unabsorbed capital expenditure on incurred on scientific research can be carried forward indefinitely, exactly like unabsorbed depreciation. Deduction under 2, 2A, 3, 2AA, which I just now told, shall not be denied if the approval of that is withdrawn. Let's say, for example, I told you here it has to be approved organizations. In future, the approval the government took back, but still they can claim that deduction. No depreciation can be claimed on a capital asset if deduction under section 35. So depreciation you cannot claim. So if you see here itself in the heading I have written only under optional tax regime. Very, very important. Now, there is a concept called as investment linked tax incentives. Means at the time of starting only these kind of businesses, whatever is mentioned in this list, if you incur capital expenditure, 100% of the capital expenditure whatever you spent will be totally given you as a deduction under section 35 AD. What are those businesses, sir? I repeat, if you start any of these mentioned businesses, if you start new business, if you are starting new business of any of these businesses, in that case, whatever capital expenditure you spend, total 100% of the capital expenditure you can claim as a deduction under section 35 AD. Let's look at what are those businesses. Cold chain facility means logistics, cold chain, yeah. Warehousing facility, cross country natural gas, hotel of 2 star or above, hospital with at least 100 beds, housing project under rehabilitation slum redevelopment project, housing project under affordable housing scheme, production of fertilizer, inland container depot, beekeeping, warehousing facility of a storage of sugar. Now, mindful, be very, very mindful. Warehousing facility for storing agriculture produce, it told. Then again it is telling warehousing facility for storage of sugar, because sugar is not a agriculture produce, boss. Any other product for warehousing is not eligible. So warehousing only agriculture produce and sugar only available. Warehousing for oil not possible. That is because oil is not a agriculture produce. slurry pipeline, a semiconductor wafer fabrication business, and a new infrastructure facility business. If you start any of these businesses and if you incur any kind of capital expenditures, then 100% of the capital expenditure is allowable under section 35AD. Conditions for claiming deduction. What are the conditions, sir? Business shall be new. I told you it should not be old business, acquiring business and all. No, very brand new business, boss. The plant and machinery, if you remember in additional depreciation, it told that I will give you additional depreciation only if you have only new plant and machinery, it told. But under section 35AD, to the extent of 20% of the total plant and machinery, you can have old plant and machinery. Yes, still you will be eligible to claim 3580 deduction. So out of 100 rupees of plant and machinery, I can have 20 rupees maximum of old plant and machinery. 80 rupees I have to have a new plant and machinery. Got it? Now, old plant and machinery imported will be treated as new only. Let's say, for example, you imported a old plant and machinery from some other country. Still, it will be considered as a new plant and machinery only. No depreciation was the earlier claimed on such a plant and machinery which you imported. Some important points regarding a 35AD. 100% deduction on capital expenditure incurred wholly and exclusively for a specified business. But mind you, boss, in capital expenditure, three kind of capital expenditures you cannot claim under section 35AD. Number one, goodwill. Number two, financial instruments. Number three, land. GFLA. GFLA. LA means land, boss. Gafla you cannot do. Basically, Gafla you cannot do. For first one is goodwill, F for financial instruments, and LA for land. These three investments, if you have done, that is not eligible for 35AD deduction. Land, goodwill, and financial instruments you cannot. One more important point. This is actually a point of section 40A3, but understand this. I told you that if you incur capital expenditure, that is eligible for 35AD deduction. But at the time of purchasing these assets which are eligible for 35AD, you have to make payment through the prescribed modes. Means through banking channels, through online payment only you have to make payment. You cannot make payment through a check. You cannot you cannot make payment through bearer check, bearer drafts, or cash mode of payment. You cannot do. Even if you do, then that asset will not be eligible for deduction. So what I told, in short, you have to make payment at the time of purchasing the capital asset. You have to make payment through the prescribed modes, means online payment or a bank through payment only. If you do payment by way of cash or even a bearer check, because bearer check is not account pay check and bearer draft is not account pay draft, so it has to be account pay check, account pay bank draft, then it is eligible. But if it is a bearer check and bearer bank draft, still you are not eligible for a deduction. Individual HUF, AOP, BOI are not eligible for deduction under default tax regime. So far, only three things I have excluded under default tax regime, boss. Number one, additional depreciation you cannot claim under default tax regime. Number two, section 35, those four things, donations, you cannot claim under deduction, you cannot claim under default tax regime. Third one is 35AD also not eligible for deduction under section 35AD. You cannot claim deduction under default tax regime. Means only if you are under optional tax regime, being an individual HUF, AOP, BOI, AJP, in that case you can claim only under a optional tax regime. Depreciation not allowed if deduction allowed. That is by default it goes, boss. Depreciation you cannot claim under section 35AD. Company paying taxes under 115BA, BAA and BAB. This is actually CA final concept. Those companies are also not eligible. Prior to commencement fully allowed. So if you have purchased the asset before starting the business itself, still you can claim the deduction under 35AD when you start the business. Once you claim 35AD, you are not eligible for Chapter 6 income related deductions. Loss of specified business can be carried forward and set off only with the loss of a specified business only. In case of hotel of 2-star or more, transfer business operations. Let's say, for example, a hotel, it started 2-star hotel or more, let's say 5-star hotel commenced the business. So whatever capital expenditure they have spent, that they claimed as deduction, but they transferred only the management, ownership and all, nothing. Only the management of the business operations of that 5-star hotel was transferred to someone else. Still it is eligible for 35AD deduction. It is mandatory to get books of accounts audited under section 44AB. You have to get your books of accounts tax audited. mandatorily in order to claim 35 AD. Now, there is a lock-in period, boss. Whatever assets you purchased on which you claimed already 100% deduction under 35 AD, you cannot sell those assets, though you cannot sell those assets within 8 years from the date of a purchase. You cannot even use those assets for non-specified business. What is a specified business? Those list you saw, no? You saw, no? Warehousing facility, storage facility, two-star hotel, hospital with 100 beds. Those are specified business. All other businesses other than these are non-specified business. If you use the asset for non-specified business within 8 years from the date in which you claimed a 3580 deduction, then there is an implication, boss. There is a tax implication. Let's have a look at this. Asset sold to outsider. You sold the asset itself outsider, then sale value is a straight away PGBP income. Means whatever amount you got by selling that asset will be straight away treated as a PGBP income. Asset transferred to other specified business. You transferred it to other specified business and anytime. But you transferred the asset to other specified business, no, which is also your own. Let's say for example, I have a two-star hotel. So let's say for example, I have a five-star hotel, one five-star hotel, specified business, no. I have a one-star hotel, is it a specified business? No. But both are owning by me only. My own two hotels, my own five-star hotel, my own one-star hotel. So I'm transferring from my own specified business that asset to my own non-specified business. In that case, no treatment, no treatment. Another transfer to other specified. I'm sorry. Five-star hotel, another five-star hotel. This scenario is different. I got confused. I'm sorry, my bad. I have a five-star hotel. I have a hospital with more than 100 beds. Both are specified business, no. Both are specified business, no. Both are specified business, no. From this specified business, I am transferring the asset. From this specified business, I am transferring the asset to another specified business. Then there is no treatment because the asset is still used in a specified business only. PGBP if asset used or transferred to non-specified business. This I was actually thinking about. Sorry, boss. So PGBP if asset. So earlier scenario we will go five-star hotel, one-star hotel, specified business, non-specified business. If I transfer from specified business to non-specified business within 8 years, in that case, I will amount of deduction claimed earlier under 3580 in the specified business less notional depreciation will be treated as PGBP income. Cost of acquisition to non-specified business. So cost of acquisition for this one-star hotel, what it will be? In that case, actual cost less notional depreciation will become its cost to non-specified business. Asset used or transferred to non-specified business after 8 years. You transfer to non-specified business, but after 8 years, in that case, PGBP to will be nil. Actual cost to that non-specified will be business will be also nil. There I have given a meaning of cold chain facility and infrastructure facility. You can just have a look at it. Now, there is a concept called as preliminary expenses. Sir, what is this preliminary expenses, sir? Simple, boss. Before starting your business, you incur a lot of legal expenses. No, you have to draft MOA, AOA, rental agreements, this agreement, that agreement, GST registration. All these are what before commencing your business, you have lot of expenses. Those expenses are called as preliminary expenses. Once you start your business, whatever expenditure you incurred before commencing your business, you are eligible to claim a deduction. But the deduction will be given in 5 equal installments. If I say 5 equal installments, can I say 1/5 will be given? 1/5 of the total expenditure will be given. But out of the expenditure which you incurred before commencing the business, only few expenses are eligible expenses. I repeat, out of the expenses which you incurred before commencing the business, only little bit amount only is a eligible expense. Out of that eligible expense, you will claim 1/5 for 5 years. Is it clear? Let's look at this. Cost which is incurred before setting up a new business or even for expanding a existing business. So business is there. You want to expand, you want to add one more unit. In that also, you expend a lot of money now before starting that unit. Even that expenditure is also eligible for deduction under section 35 D. Now, applicable to only Indian companies and resident non-corporate means it is not applicable for non-residents and foreign companies. In case of new business, expenses incurred before commencement. In case of expansion, expenses incurred till the date of commencement will be eligible. How much is eligible, sir? 1/5 is eligible. 1/5 of here one word is used, boss. Eligible, eligible, eligible. We will just shortly look at what is eligible, sir. Now, eligible expenses. Preparation of feasibility report, project report, market survey, all these are expenses which you incur before starting the business. Legal drafting of MOA, AOA, registration of company and all. Now, how much deduction I can claim, sir, under section 35AD? Amount eligible for amortization. Amortization is nothing but 1/5 you are doing. No, that is called amortization. Getting it? Now, nature of assessee. Maximum eligible amount. Maximum eligible amount. Whatever maximum eligible amount you will get here, on that you will calculate 1/5. Amount of deduction each year. Are you getting it? So, on what you will calculate 1/5? On the maximum eligible amount. Clear? Now, if you are a resident non-corporate, means you are not a company, but you are a resident. In that case, 5% of the cost of project is eligible. Sir, what is cost of project, sir? We will discuss that. Then amount of deduction will be 1/5 of the maximum eligible amount. Indian company, if you are an Indian company, higher of these two will become maximum eligible amount. On that you will claim 1/5. What is these two, sir? 5% of the cost of project or 5% of capital employed, whichever is higher. On that 1/5 you will claim. But keep in mind one thing, this maximum eligible deduction should not exceed the actual expenditure which you incurred. Now, what is cost of project, sir? Cost of project is very, very simple, boss. Actual cost of all the fixed assets, whatever is there, as on the last day of the previous year of the means, let's say, for example, this year I started my business. In this year, as on the last day of this year, in the year in which you started the business or expanded the unit, on that day, whatever the total value of assets were there in the books of accounts, that is cost of project. But of the cost of project, 5% is eligible. Because here what you wrote, 5% of cost of project. Getting it? Next. Sir, what is capital employed, sir? What is capital employed, sir? Capital employed is nothing but issued share capital plus debentures plus long-term borrowings. But keep in mind one thing. Keep in mind one thing. You will not include reserves and supplies and securities premium in the capital employed definition. Is it clear? So I will take, if I am a non-corporate assessee, means I am an individual or HUFO and all, I am starting a new business. In that case, my eligible deduction will be 5% of cost of project on that 1/5. So maximum total deduction, how much I can take? 5% of cost of project. But maximum amount I will take, on that 1/5 I will calculate and do it. It is mandatory to get your books of accounts audited in order to claim this 35D expenses. There is something called as a voluntary retirement scheme for which the employer or the company expends. On that also 1/5 will be eligible. Now, whatever we have seen right from section 30 till section 35, all there was specific, they were specifying this section 32 depreciation, section 35D preliminary expenses, 35AD specified business expenditure. But apart from that, whatever expenses you will incur for your business purpose will be eligible for deduction under section 36. So this is a all other deductions. Sir, what are these, sir? If you have taken the insurance for your business purpose, if some fire happens, sir, your stock will be gone. No, so that kind of a business purpose insurance, if you have taken, for that premium, whatever you paid will be eligible for deduction. Premium paid by employer on health insurance of employees. So for purpose of employees, if the employer has taken means the company is taking any health insurance for its employees, the premium whatever paid for the group insurance policy, that will be eligible. Bonus and commission, boss. Bonus and commission, keep in mind one thing, it is subject to 43B section. But what is 43B, sir? We will just very shortly see. In simple terms, if I have to summarize, section 43B is nothing but you have to actually make the payment on or before the due date of filing return of income under section 139(1). Only then you will be eligible to claim a deduction. Interest on borrowed capital. Interest on borrowed capital. If you have taken a loan for a business or profession, you can claim deduction. If you have taken loan for personal purpose, it is not eligible. This is also subject to 43B. Discount on zero coupon bond. What is a zero coupon bond? Zero coupon bond are generally issued at a very discounted price, and they will not pay any interest on that. At the time of redemption or the actual cost, they'll give you money, actual face value of the bond. How to calculate the deduction, sir? Deduction is very simple. There is a very simple formula, and I've given an example also. You can have a look. Discount amount divided by life of a bond in months into number of months in current previous year. If you do, you will get it. Now, contribution by employer to provident fund and other funds. See, in salaries chapter, in our marathon discussion itself, in the salaries chapter discussion, I have beautifully explained you the whole concept of provident fund. In that, I told you there are two kinds of contribution: employer contribution, employee contribution. Employer contribution, employee contribution. So your employer would be doing business, no, then only you are working as an employee, no. So if your employer is doing business, he is contributing for him, that is an expenditure from the business, yes or no? That expenditure, that employer contribution which is making for the funds means for employees sake, he is giving the contribution into the funds. In these funds, if he contribute, in that case, it is eligible for deduction under section 36(1)(4) and 5. But this is also subject to 43B. Sir, what are those funds? Statutory, recognized, approved superannuation, gratuity, and any other fund of law. There are few funds to which even if the employer, even if you being a business person donate or contribute, still you are not eligible for deduction. Not allowed. These are not allowed. Unrecognized, unapproved, you will see. So if it is unapproved or unrecognized, you are not eligible for deduction. If you being an employer, being a business person, you are contributing to these funds. Is it clear? Next. Employer contribution to national pension scheme. So for a national pension scheme of an employee, if employer contributes something, then up to the maximum of 14% of salary of employee is eligible. If the employer contributes more than 14%, that will be disallowed. What is a salary definition for this, sir? Basic plus a DA in terms. Sir, what is DA in terms, sir? Go under revised salary chapter. Employees contribution towards welfare funds. Now see, one concept I want to explain you, boss. Beautifully, I'll explain. Just give me 2 seconds. Okay. See, in contribution, there are two kinds of contribution. One, employee contribution. The other is employer contribution. So there are two contribution. Employee from his own salary, he will have to contribute. Employer from his own profits, he has to contribute to the funds, recognized provident fund or whatever. So how does it actually work? See, at the time of making a payment of salary to the employer will deduct the employee's contribution from his salary, and he will keep it with you, with the employer himself. I repeat, at the time of making a salary payment to the employer will deduct a little bit part from the employee's salary and keep it with the employer only. Next, the employer will get equal contribution from his own money. Take this to both the money he will take and contribute into that fund. So there is the employee's contribution which is deducted from the salary of the employee, and there is an employer contribution which from the own pocket of the employer he is contributing. So there are two kinds of contributions: employee contribution and employer contribution. Employee contribution has to be deposited within the due date of the respective fund only. What is the due date, sir? Let's say, for example, provident fund. For a recognized provident fund, your employer deducted from your salary, employee's contribution. That amount has to be deducted within the due date given under the PF Act. Let's say, for example, the due date of as per the PF Act is 15th of next month. So let's say, for example, this month is March. No, if I deducted from your salary on March, in the month of March, I have to deposit it from the March salary. If I being an employer, I deducted from your salary, I have to deposit it before 15th of April. 15th of every month, the due date is there. So if I deducted from the your March salary, I have to deposit the employer means your employees contribution. Your employees means your contribution I have to deposit within 15th of next month. So employees contribution has to be deposited within 15th of the next month. But employer contribution, the employer can deposit before filing of a return of income within the due date of 139(1). I repeat, employees contribution has to be deposited within the due date of the respective Contribution Funds Act, whereas the employer's contribution can be delayed and can be deposited even till the due date of filing of return of income. Is it clear? If the employer deposit the employee contribution after the due date of a PF Act itself, then it will be disallowed. Employees contribution toward a welfare fund. Employees contribution collected by employers shall be deposited in the fund within the due date given in the respective act. If not deposited, then such employees contribution shall be taxable as income. PF due date is 15th. CBDT clarification. That is what I was discussing about. Employees contribution shall be deposited within the due date of respective fund, but employer contribution can be deposited even before a date of filing a return of income. Now, there is a concept called bad debts. Bad debt means what? You sold goods to someone, but he did not give you money. You gave loan to someone, someone did not give you money back. That is called a bad debt. But mind you, under this the section of 36, you can claim only that bad debt which happened or which generated due to sale of goods. If you have given loan to someone and someone did not repay you that loan, that you cannot claim under this section. Only those revenue transactions will be covered here. So you sold goods to someone, that person did not pay you money, that you can claim as bad debt. But provided you actually are claiming that bad debt in your books of accounts, provision of bad debts is not allowed. Actually bad debt, if you are reducing from your income, that is allowed. Provision for bad debts not allowed. Actual bad debts on sales allowed. Bad debts on loan not allowed. Actual bad debt on loan for a banking business, it is a revenue, no, normal business, normal transaction. So for banks, if a loan was not repaid by someone, that is allowed. Next, family planning promotion. If the employer is expending something for the family planning of employees, in that case 5 equal installments, exactly like in the case of voluntary retirement expenditure, it will be allowed. STT cost and CTT cost, securities transaction tax and commodities transaction tax, will be allowed as expenditure only if you are into business, or allowed if you are into business of trading in securities and commodities. Now, residuary expenses. So these are the expenses which are apart from a given under section 30 to 36. Here a few expenses you will keep in mind. Few you have to just have a look and keep it in mind. Income tax, surcharge and health and education says whatever you pay for your own self. Income tax, health and education says and surcharge is not eligible for deduction. So whatever business profit will come, that business has to pay tax on that. No, that income tax or surcharge assess is not eligible for deduction. Interest on income tax not eligible. Penalty under any law. See, penalty for a breach of a contract is allowed, because contract is not a law. No, contract is you and the other party, you made agreement, you made a contract. That breach penalty is allowable, but penalty for a breach of law is not allowed. CSR expenses are also not allowed. Then what are allowed, sir? GST if you pay, that is allowable as a deduction. Interest on GST allowable. Penalty for breach of contract is allowable. There are some inadmissible deductions. See, what we have discussed so far, section 28 we discussed those incomes which are taxable. Less deductions, allowable expenses, right from section 30 to section 37 we saw. Now what I am going to discuss is amounts which are not admissible, means disallowed. You might have already reduced in your P&L account, but you have to add it back now, because those are inadmissible deductions, means you cannot claim expenditure, as you cannot claim these as a expenditure. What are those, sir? Number 1, 40A1 and 40A1A. Let's say for example you are making some expenditure. but that expenditure, you have to make payment for that expenditure to some non-resident or a foreign company. You have to make payment to a non-resident or foreign company for that expenditure. But at the time of making a payment to the non-resident or foreign company, you did not deduct TDS on that expenditure. In that case, 100% of that expenditure will be disallowed. Let's say for example, you are making some commission payment to a non-resident. Commission, you are eligible for a expenditure no in your books of accounts on the in the P&L. Commission you can debit as expenditure or not. Yes, you can debit as expenditure, but at the time of making this commission payment to this non-resident or a foreign company, you forgot to deduct the TDS on this commission payment. In that case, 100% of the commission amount will be disallowed. In that case, you have to pay tax on that commission amount. Same scenario, but if you are making payment to any resident, if you are making payment, let's say for example, I am paying to my landlord rent for my business purpose. I'm paying rent. At the time of paying rent, I was supposed to deduct TDS, but I did not deduct the TDS. In that case, 50% of the amount of expenditure will be disallowed. Let's say for example, I am paying rent of 10,000 and I did not deduct TDS. In that case, 30,000 will be disallowed, 70,000 will be allowed as a expenditure. There is one more thing. Let's say, for example, at the time of making this payment to my landlord, I did not deduct TDS. But my landlord is a very beautiful person. What he did, he went and he realized that I did not deduct TDS because he got total 10,000 in his hands. No. So he realized, boss, this person forgot to deduct TDS. So that expenditure will be disallowed in his hands. He has to pay tax. Let me do one thing. Let me file return of income. Let me only offer this income on tax for tax purpose. Let me only pay this tax on this income. In that case, if the person who has received the payment has make the payment of taxes on that income which he received, has filed the return of income and already offered that income to tax, in that case, disallowance will not be made in the hands of the payer. Are you getting this? If the payer fails to deduct TDS, but pay reports the income, files a return, and provides a certificate from an accountant, then there is no disallowance. Similarly, in the case of a salary to a non-resident, salary paid outside India or to a non-resident, if a TDS is not deducted, without deducting TDS, you paid a salary to a non-resident or a foreign company, 100% of the payment what you made will be disallowed. Tax on non-monetary perquisites. So in salaries we had revised monetary perquisite, non-monetary perquisite and all. Yes or no? So non-monetary perquisites, whenever you are giving to your employee, if let's say for example, you are giving non-monetary perquisite to your employee, then the employee is getting benefited. Then employee has to pay tax, no. But let's say for example, you yourself told employer yourself, you are an employer and you yourself are telling that, boss, I will only bear the tax. You no need to worry about the tax. In that case, employee's tax responsibility, if the employee is bearing, in that case, that expenditure of taxation what the employer is bearing will not be allowed as a deduction. Tax on non-monetary purposes generally paid by employee. However, if employer pays tax on behalf of employees, that will not be allowed as business expenditure in the hands of employer. Now comes a very, 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 very important, because there is an amendment in this section, was section 40B. When I started this PGBP discussion under section 28, the first dialogue we used is interest, salary. Sorry. The first dialogue we used is interest, salary, bonus, commission received by a partner from a partnership firm is taxable under the head PGBP. We discussed. Yes or no? Yes or no? Yes or no? Now, that income which is getting taxed in the hands of partner will be taxed only to the extent allowed under section 40B. What is this, sir? We are not getting this. Let me explain you in a beautiful manner. See, partner is different. Partnership firm is different. Yes or no? Partner individually he has to file his income tax return. Yes or no? He has to individually he will file his own income tax return. Firm again is a separate person, separate entity. It will also file its income tax return. So partnership firm while computing its PGBP, it has to reduce whatever expenditures are there. In that expenditure, one of the expenditure will be salaries paid to partner, interest paid to partner, bonus paid to partner, commission paid to partner. These are all expenses, my boss. Yes or no? But there is one section which is section 40B. What does it say, sir? What is 40B's problem? 40B's problem is that it will allow only few or part of payments which are made to partner. It will not allow full payments. Whatever you made to partner, that will not allow in full. It will restrict. It will disallow part of it. So if you disallow means that disallowed expenditure is already taxed in the hands of partnership firm. That disallowed expenditure due to section 40B will already be taxed in the hands of partnership firm. Then the same amount cannot be taxed again in the hands of partner. No. Yes or no? So whatever 40B allowed, whatever expenditure 40B allowed, did the partnership firm pay tax on that? No, it did not pay because it was allowed as a deduction. No. So that 40B allowance is a tax hand in the hands of a partner. In very simple words, if I have to tell boss, let's say for example, 10,000 is the salary of a partner, which the firm has to pay to the partner. Yes or no? Out of that 10,000, let's say for example, only 8,000 is allowed by section 40B. Means 2,000 disallowed. Yes or no? Disallowed. Disallowed. Now tell me, on this 2,000, who will pay tax? Firm will pay tax. Because it is disallowed, no? On this 8,000, who will pay tax? You know, partner will pay tax. So whatever 40B allowed in the hands of the firm, the partner has to pay tax under PGBP. Whatever disallowed, 2,000 rupees, the partner will not pay tax. Are you getting this? So 2,000 will not again go and become income of a partner. It will not become, because that is already paid tax by the firm. I hope that is clear. Now we will look into what is disallowed, sir. Are you getting it? Now, before even starting, you must have heard in your law subject there is something called as a partnership deed. What is a partnership deed? Whenever a partnership firm comes into an existence, it has to prepare a partnership deed. It is a paper in which all the agreements are written. Yes or no? Partnership deed has to authorize the partnership firm pay partner remuneration and interest, any kind of payments. If in the partnership deed it is not authorized, then zero you will get a deduction. Nothing you will get deduction. Are you getting it? Let's start. Following payments made by partnership firm shall be disallowed. We are looking at those expenses which 40B has a problem with. It disallows it. Are you getting it? Means these payments will be taxed in the hands of the partnership firm. Salary, bonus, commission, remuneration to non-working partner. You must have read in law, sleep-in partner, working partner. So if you are paying, so section 40B says that if the payment is made to any salary, bonus, commission made to non-working partner, it will disallow. Remuneration to working partner not authorized by deed. Just now I told you, if in the partnership deed, nowhere it is written that partner is eligible for remuneration, partner is eligible for interest at the rate of 12%, 13%. If it is not mentioned in the partnership deed, then whatever remuneration paid by the partnership firm will be disallowed. Payment related to a period before partnership deed. Very, very important, boss. Let's say for example, you started a partnership firm in the month of June 2025. For example, you started partnership firm in the month of June 2005. Let's say for your easy thing, I will take Jan, boss. Jan. Let's say for example, you started your partnership firm in the month of 2025. But at the time of starting the partnership firm, you did not have any partnership deed at all. You did not create a deed. But in the month of June, June 2025, you created partnership deed. And in that deed, you are writing, you all partners are writing that partners are eligible for monthly remuneration 10,000 rupees. For example, it is written. So let's say, for example, all the partners get remuneration yearly once. That too in the month of December, for example, they get. So in the partnership deed, it is written that in on a yearly basis in the month of December end, in the month of December end, we will pay salary. The firm will pay salary to all the partners. It is written, for example. But when did they create the deed? In the month of June. When did they start the business or the firm? In the month of Jan. Now the law says section 40B has an issue here. 40B says, no, I will not accept whatever remuneration you are agreeing to pay before creating the partnership deed. I will not allow. Means for the period of Jan to June, for the duration for which you did not have deed, you created the deed itself in the month of June, but you cannot authorize the payment before the date of creating the deed. So whatever Jan to June partners remuneration will be paid by the firm, no, that will be disallowed in the hands of firm. They should have created the partnership deed in the month of Jan itself. Then only full year's salary would have been allowed as an expenditure in the hands of partnership firm. They created deed later, but they thought that we will include the past periods remuneration also in this, but that is not accepted. I have given you a beautiful example. You can just read it. Now, interest up to the rate of 12% per annum only allowed by 40B. Let's say, for example, in the partnership deed, it is so beautifully written with color coded. It is written interest on partner's capital eligible for 20%. It is written. Still, 40B has issue. It says, boss, maximum 12% I will allow. You write 100% also there. I will not allow. So, whatever excess interest is there, you have to disallow in the hands of firm. There is a concept called representative assessee and individual capacity. Representative capacity and individual capacity. Let's understand. See, a firm, partnership firm can be created by individuals generally. A HUF cannot become a partner in a partnership firm, but HUF can be represented by Karta as a partner. Means, let's say, for example, there are three individuals are there as a partner in the partnership firm. They want to get one HUF as a partner, but HUF cannot become a partner in a partnership firm legally. That is a problem. So what they will do, they will add the Karta of that HUF as a partner. So that Karta is not individually partner. He is not individually partner. He is in a representative capacity. He is the partner. So he is representing the HUF. Are you getting this? Individual capacity partner means those three partners already are there. No, three partners. They are in the individual capacity partners. But the Karta who will come in the books, in the name of the partnership deed, this individual, the Karta's name will be written. But in bracket, they will write as a representing so and so HUF. So three partners are in individual capacity. One partner who is coming on behalf of HUF will be representative capacity partner. Are you getting this? Why are you telling this, sir? Because you will not understand this table otherwise. Are you getting this? Yes. Partner on individual capacity means you are individually you are a partner. You are not representing any HUF. Interest received on individual capacity. Of course, no. For you being a partner, you are receiving interest. In that case, treatment maximum 12% interest only allowed because you are receiving the interest as a partner, you being a partner. Number two, representative capacity means you are representing a HUF as a partner. Interest received on representative capacity means the interest which is paid by the firm is on the partner's capital, means on the HUF's capital. That also limit of 12% is applicable. Partner on individual capacity. I am partner on individual capacity. I am not representing an HUF, but receiving interest on representative capacity, receiving on behalf of a HUF. In that case, limit of 12% shall not be eligible. Partner on individual capacity, interest received on a representative capacity. In that case, limit of 12% not applicable. I am a partner on representative capacity and receiving interest received on individual capacity. In that case also limit of 12% will not be applicable. 40B limit of remuneration is applicable both in the case of individual and representative capacity. Is it clear? Now, sir, interest you told maximum 12%, but what about remuneration, sir? Is it fully allowed? No, 40B has an issue, and 40B has given a beautiful method or a method of computing the disallowance and allowance. How much is allowed is given here. See, remuneration in excess of the below prescribed limit is disallowed. Means to the extent of this much is allowed. Whatever you pay remuneration beyond this will be disallowed. How much it is allowed, sir? 6 lakhs of book profit, higher of 3 lakhs and 90%, other balance of book profit 60%. Sir, first 6 lakhs of book profit you will take. Out of that you will compute two things. One, 3 lakhs and 90% of book profit. 90% of book profit means this is 6 lakhs of book profit, not the total 90% of not total. Then whatever balance book profit is there, on that you will take 60%. Let me take one simple example. Let me take 10 lakhs then. This is my book profit, boss. 10 lakhs is my book profit. Means out of that 10 lakhs, I will have 6 lakhs and 4 lakhs also. I can break this 10 lakhs into 6 lakhs and 4 lakhs. On this first 6 lakhs, I have to take two things. One, 3 lakhs. Or 90% of 6 lakhs will be how much? 90%, 6 lakhs. 5 lakh 40,000. 5 lakh 40,000. Let me read nicely. 5 lakh 40,000. So 5 lakh 40,000 or 3 lakh, whichever is higher, I have to take. Whichever is higher is what? 5 lakh 40,000. Then rest balance of book profit is how much? 4 lakhs. No. On that 4 lakhs, I will compute. On that 4 lakhs, I will have to compute 60%. 4 into 4, 6 are 24. No. Means 2 lakh 40,000. So total is how much? 540 plus 240. 780. 7 lakh 80,000. So up to 7,80,000 I can pay remuneration to partners. Beyond that, even if I pay, that will be disallowed. Let's say, for example, I paid 9 lakhs as the remuneration. Means the firm paid a remuneration of 9 lakhs to its partner. In this case, 1,20,000 will be disallowed. Just 7,80,000 will be allowed. I hope that is crystal clear. Now, what is book profit, sir? Actually, book profit means profit as per PGBP before deducting remuneration, but after deducting interest deduction. Means simple, boss. Take the profit, do all kind of adjustments, but except this remuneration adjustment under 40B, that is called as book profit. On that you can compute. See, actually there is one section 194T which is added by Finance Act 24, but that applicability is from 1/4/2025. 194T means on whenever the firm will pay remuneration and all to the partner, it has to deduct TDS. That is not applicable till 31st of March 2025. From 1st April 2025 it is applicable. Now, payments to relatives and associates. Lot of time what happens? See, we are calculating profit, no? Any business would want that their profit should be less only. So no, sir, profit should be higher, sir. We should earn more money, boss. You want to earn more money, but you don't want to pay tax on more money. Yes or no? So profit they want to disclose all the time less only. How to reduce the profit? Either reduce the revenue or increase the expenses. Yes or no? How to increase the expenses? You show more bigger entries. You paid actually 10,000. Show 20,000 as an expenditure in your books of accounts. That is what you think. Yes or no? That is why this section has come. 40A2. It says that if you have made payment to any or known person more than the general limits, in that case, whatever excess payments you make, whatever excess payments you book in your books of accounts, unfair expenditure which you book in your books of accounts will be disallowed. Who is a relative, sir? It is given here. If you are an individual so and so, if you are a company so and so and all, you can just read it. Now, very important section 40A3. See, 40A3 says that it has only one problem, boss. Make online payment. Like Modi says, no, all online, digital India. Yes, digital India supported by 40A3. 40A3 says if in a single day to a single person for a single expenditure, if you have made payment more than 10,000 rupees, aggregate, in that case, that total excess whatever you made payment other than the prescribed modes will be straight away disallowed, boss. Are you getting this? If any payment or aggregate of payment exceeding 10,000 made to a single person in a single day other than the prescribed modes, that will be disallowed. Mind you, crossed check or a bearer check is a kind of cash only. Even though it is a check, it is not a through prescribed mode payment. Now, In the case of transport operators, if you make payment, the limit is not 10,000, the limit will be 35,000. So for a transport operator, if you make payment up to 35,000, you can make payment in a other than prescribed modes. Cases where disallowance will not be attracted. Rule 6DD it is called, means there are few exceptions, means there is no bank in that, on that day bank was not working, or commission agents if you make payment. If you make to bank, payment to bank itself. Let's say for example you went to cash deposit. What they'll ask you, get the banking mode? No, now you have to make deposit of cash. So if you make any payments to banks and all, that is the okay, you can make in cash. If you are purchasing any agriculture produce, or if you are making any payment to cottage industry, if you are making payment of retirement benefits up to 50,000, all these cases are not required to make payment through online mode only. Even if it is made in cash, that is still fine. Gratuity provision. See, provision is generally not allowed under income tax, boss. Actual expenditure should be there. So for provision of gratuity, you can claim expenditure, but gratuity you are creating for a payable offer this year only. Let's say for example for an employee you are eligible, we are liable to pay gratuity this year only. For that, if you are creating gratuity, good enough. Otherwise gratuity is a provision for gratuity is not allowed. If you are actually making payment of gratuity under claiming it as deduction, it is good enough. 43A foreign exchange reserves. Let's say for example I purchased an asset from outside India, then of course that person would have billed me in dollars, no, foreign currency, no. In that case, he created the bill one day, $90, $100, whatever. But maybe I am making a payment on a some other day. In that case, the foreign exchange fluctuation will be there. No, due to that fluctuation, I may have a loss, or I may have a gain. If there is a foreign exchange loss, add it to the block of asset. If I am purchasing any asset to which I am supposed to make payment, in that case, if there is a foreign exchange loss, add it to the block of asset. Foreign exchange gain have to be reduced from the block of asset. Next section is 43B. See, there is a due date called as a due date of filing return of income given under section 139(1), boss. Given under section 139(1). Generally, since we are under in CA Inter, one due date you remember, which is 31st of July you remember. Generally, in the case of individuals, the due date is that only. For example, for expenditures, for few expenditures, whatever is mentioned here, if you have not made the payment before filing the return of income before the date given under 139(1), which is 31st of July, you are not eligible to claim deduction. Means you are just making entry in books of accounts as payable, but you did not pay it before 31st of July of the next financial year, which is 39(1) due date of filing return of income. In that case, total expenditure will be disallowed. Deduction of the following sums can be claimed only if such payments are made on or before the due date of furnishing the return of income under section 139(1). Sir, what are these expenses, sir? Let's have a close look at it. Any tax, duty, cess or free by whatever name called under any law. And employer contribution. Just now we discussed employee contribution has to be deposited. In order to claim deduction has to be deposited within the due date of the respective PF Act. But employer contribution can be delayed only till the 139(1) due date. Bonus or commission, I told you there itself, 43B. Leave encashment, use of railway assets. You are using any railway assets, and for that you are paying making any payment that has to be made within a 139(1). Interest on any loan you take from any public financial institution, any bank in that case, or you are taking any loan from a cooperative bank. In all these cases, you have to make payment before 139(1) due date, which is 31st of July in the case of individual. If the individual who is doing business has not made the payment within the due date, then that expenditure will be disallowed. Mind you, conversion of interest payable into loan. Interest you are converting into loan, that is not a payment. Are you getting it? Deduction will be allowed in the previous year in which the converted interest is actually paid. Only when you will actually make the payment of interest, then only it will be allowed. Otherwise, it is disallowed. Clarifications under section 43B. Whatever I clarified earlier, 43B is clarifying now. Contribution to welfare funds. Employees' contribution to welfare funds deducted from salary and considered as income under section 224 only if employee contribution is deposited within the due date of the respective fund. Deduction will be allowed. Employer contribution, if deposited within due date of 1391, allowed. Payment to MSMEs, very, very important, boss. There are few entities which are called as MSEs, means micro and small enterprises. Sir, what are these micro and small enterprises? Let me explain you that. Micro enterprise means the investment in plant and machinery and equipment is up to 1 crore and the turnover is up to 5 crore. And both conditions, if they are satisfying, and then only it is called as a micro enterprise. Sir, what is a small enterprise, sir? Plant and machinery or equipment, investment up to 10 crore, turnover up to 50 crore. This is the MSE. You got to know what is MSE now? Micro and small enterprise. You know what is the enterprise? Now, what happens in this? Let's say, for example, you purchased some products or goods from a MSE entity, medium and a small entity, medium and micro and small entity, micro and small entity. You purchased some product, boss. Then the government says, or this section 43B says, you have to make a payment within the prescribed time. I purchased a good from or a product from MSE, micro and small enterprise. I will tell him, I will give you I will give next month. I will give you. Then I have to book expenditure in my books of accounts now for purchases. That will be disallowed if I don't make the payment within the prescribed times to that MSE entity. What is that prescribed time, sir? There are two things. One, if there is an agreement between you and the MSE regarding the time of payment. Let's say, for example, I got into agreement with my MSE. Boss, I will make you payment within 30 days. Means there is agreement now. Yes or no? I told that I'll make payment maximum within 30 days. So there is agreement. And there is another scenario. I did not have entry into any agreement. There is no agreement at all. And I just told that I will make payment. That's all. When I will pay, there is no agreement. So there are two scenarios. Agreement is there, agreement is not there. In case if you have agreement, the maximum time which you can agree is 45 days only. You can say, okay, 30 days, within 30 days, I'll make payment. Good enough. Within 45 days, good enough. Hey, I will make payment within 60 days. You write in this agreement. Not eligible. Maximum 45 days you can agree. And if there is no agreement, mandatorily you have to make payment within 15 days. 15 days only. If there is no agreement. So if there is agreement, maximum within 45 days you will make payment. Even though in agreement you might have written within 90 days, 100 days. No. Within a maximum 45 days you have to make payment. If there is no agreement, maximum within 15 days you have to make payment so that you can claim that the purchase amount as the deduction in your books of accounts. Let's look at this. If payment is delayed, that shall be disallowed in the one second, one more thing. You did not make the payment within 45 days, but you made the payment later on. Then at the time of making payment, if it is a different financial year, you will get that allowance. We will look at this with the help of a beautiful example now only. Don't worry about that. Time limit. Payment against the purchase of goods or services from a MSE shall be mandatory, boss, on or before the agreement date. Agreement date should not be more than 45 days. Got it? If there is no such agreement, then the payment shall be made within 15 days. Within agreement date, if the payment is made, deduction available in year of purchase. If payment made after agreement date, deduction available in the year of payment. Sir, please explain, sir. Yeah, we will explain. First example, boss. Thalaiva Limited, Mr. Thalaiva Limited, purchased goods from Thalapathy Limited. 20 lakh rupees worth of goods was purchased on 2nd of March. Remember this date of a purchase, 2nd of March. As per written agreement, payment is to be made up to 30th of April 2025. Means they agreed that the payment has to be made before 30th of April. Now, if you take the difference, how many days they agreed? Do you know? They agreed for more than 45 days, boss. It is more than 45 days, definitely, because 2nd March to 2nd April, 30 days. Again, from 2nd to 30 days is more than 20 days. So 30 plus 20 is 50 days already. So they agreed for more than 45 days or not? Means Thalaiva Limited purchase, no. So Thalaiva Limited has to make payment within 45 days. Though they agreed in the agreement that payment has to be made before 30th April. They agreed for more than 45 days. But I told you, the payment has to be made within 45 days if there is agreement. If there is no agreement, the payment has to be made within 15 days. And Thalaiva Limited made a payment to Thalapathy Limited like this on 30th March, a little bit payment, 6th April 4 lakhs, 15th April 3 lakhs, 6th May 6 lakhs. So let's look at how, in which year it will be disallowed, which amount will be disallowed in the which year, which amount will be allowed in which year. In this case, agreement is made for more than 45 days. Therefore, payment shall be made within 45 days from the date of purchase. Date of purchase of goods is 2nd March. Due date for payment is 16th April. Why 16th April? That is the 45th day of from the date of purchase. That is 45th day. Payment made up to 16th April. Up to 16th April will be allowed in the same year, but the payment made after 16th April will be allowed, but it will be allowed in the next financial year. Let's look at this. See, this 2 lakhs of payment, the actual date of payment was 30th March, whereas the payment is required to be made before 16th April. No. So here, before or after means whether the payment was made before 16th April or after 16th April, this column will tell you. So 30th March was the actual payment date. Did he make the payment before 16th April? Yes, it was made. So allowance of deduction will happen in financial year 24-25 only. Now you should have one doubt here, sir. Payment made on 16th of April. Sorry, payment made on 30th of March 2025. So deduction allowed in 24-25 good enough. Let's say in the next scenario, 6th April the payment was done. Is it before 16th April? Yes. But deduction you are claiming in 24-25, sir. How is it possible? Because 24-25 financial year ends on 31st of March 25 itself. No. The payment year is done on 6th of April 2025. Means the payment is done in the previous year 25-26. No, sir. Why you are claiming the deduction in 24-25? Because the payment was done within 45 days. That is why we are claiming. That is why we are claiming. That is why we are claiming. In 15th April scenario, the actual payment date of this 3 lakhs was 15th April. It was also done before only. But 24-25, 24-25, 24-25, the payment was done. Just give me a moment. Yeah. So, if you look at this, 3 lakhs payment was done on the 15th of April. 3 lakhs payment was done in 15th of April 2025. Means in which financial year? 25-26. Is it before 16th of April? Yes. But the deduction you will claim in 24-25 only. Why we are claiming in 24-25 and not 25-26? Because the payment was done within 45 days. This last payment of 6 lakhs, if you see, the actual date of payment was 6th May 2025. But the payment was after, so it will be claimed in 25-26 financial year and not 24-25 financial year. I hope that is clear. Very simple put together, boss. This kind of a scenario happens only in the month of March sales only. This will not happen during the April to February sales. Why? Because April to February, whatever sale will be made by MSE, it will get payment maximum by 100 days or 200 days, so it will get. But the payment, though it is made after 45 days by the purchaser, it would have been paid in that previous year itself. No, so they will get the payment. The payer will get deduction in the same previous year. Second example, if there is no agreement between the parties, then within how many days the party has to make payment? Within 15 days. Yes or no? As there is no agreement, the payment shall be done by Thalaiva Limited within 15 days from the date of purchase on or before 17th of March 2025. Means 15th day is 17th of March 2025. If payment made before 17th of March 2025, then the deduction will be allowed in the same year. If the payment made after 17th of March 2025, then the payment will be allowed. The expenditure will be allowed in the next financial year if the payment itself is made in the next financial year. See, 2 lakhs of amount, actual payment date received by MSE was 30th March, but it was supposed to be received before 17th March. No. Has it received? No. Means the payment is delayed. Payment is delayed. But the payment is done on what? 17th of March. But you remember, here 17th March itself the payment is made. Though it is delayed, the payment is made during which financial year? 24-25. Yes or no? Before 31st of March 25 itself it is made. So the deduction is available in 24-25 financial year. But in the next scenario, 4 lakhs, actual payment date is 6th April, boss. Is the payment done before 17th March? No, after. After means the payment date. Whenever the payment date is that in that financial year, you will get deduction. When is the payment date here? 6th April 25. Means so it is falling in which financial year? Financial year or previous year 25-26. So the deduction will be available in PY 25-26. Is it clear? 3 lakhs payment made, actual payment on 15th April. Is it before 15 days? No, after 15 days. So it will be eligible for deduction in the year in which the payment is made. 15th April, if the payment is made 15th April 25, the deduction will be available in the year 25-26. 6 lakhs. Payment is made on 6th of May. Is it before 17th of March 25? No. So deduction will be available in the year previous year 25-26. I hope that is clear. So the next section is section 43 CA. What is this section trying to say? See, let's say for example, you are in a real estate business, boss. If you are in a real estate business, what do? You buy properties, you sell properties. Means properties is your stock in trade. Means the building will become your stock in trade. Yes or no? And how do you compute PGBP? If you are selling a stock in trade, you will take sale value less whatever cost of acquisition, that will become your PGBP. But this sale value is very, very important. What sale value means? Let's say for example, I am selling a building for, let's say for example, 1 lakh rupees. Whereas the stamp duty value of that building is 1,20,000 rupees. Now, what is the stamp duty value? Stamp duty value is that value which is decided by the revenue authorities. Means as per the revenue authorities, as per the tax authorities, they think that this building should fetch at least 1,20,000 rupees. That is called a stamp duty value. But you showed sale value of only 1 lakh rupees, no boss. Means because of showing 1 lakh rupees, the tax authorities will lose a tax revenue or not? Yes or no? Because if your sale value has reduced, the tax will reduce. Because if your sale value reduces, profit reduces, then tax will reduce. That is why the stamp duty value are decided. And if the stamp duty value is by more than 110% of your sale value, in that case you have to consider stamp duty value only as your sale price for the purpose of computation of profit for PGBP. So in this case, you will not take 1 lakh as your sale value for PGBP computation. You have to take 1,20,000. Why? Because your sale value is 1 lakh and your SDV is 1,20,000. Means the stamp duty value is more than 110%. No. What percentage it is? 120% of your actual sale price it is. So SDV value in this scenario, the SDV value is 120% of sale value. So that is why in this case, you will not take your actual sale value as a sale value. You will take stamp duty value as a sale value. So what is given here? Let's see. Applicability: land or building sold as a stock in trade. Stamp duty value is more than 110% of actual sale value or consideration. So if more than 110%, if the SDV is more than 110% of actual sale consideration, sale value to be considered is stamp duty value. If stamp duty value is less than 110% of sale consideration, then sale value to be actual sales consideration. Let's say for example, one more example I'll take. The actual sale value is 1 lakh. Actual sale value is 1 lakh. Stamp duty value is only 90,000. Means you are offering more than a stamp duty value. In that case, there is no issue. Got it? Next. In some cases, it may happen so that the date of agreement and the date of registration is different. In that case, which date's stamp duty value you have to consider? That is the question. Very simple. If on the date of agreement, if you have received any part payment through the prescribed modes of payment, means online payment or bank through payments, in that case, the stamp duty value as on the date of agreement you can consider. If you have not received any part payment, or even if you have received part payment but other than in prescribed modes, if you have received, then the stamp duty value as on the date of registration only you can consider. So date of agreement, date of registration are different. In that case, at least a part of the consideration is received in prescribed modes on or before date of agreement, then stamp duty value as on date of agreement may be considered. Let's say, for example, you are not satisfied with the stamp duty value which is taken by the government. In that case, you may argue with the assessing officer, boss, the stamp duty value is very much higher than the fair market value of this property. This is not fair. In that case, the assessing officer, what he will do, he will refer to a valuation officer so that you can get the property valued. And if that valuation officer, the value given by valuation officer, if it is less than the stamp duty value, in that case consider such value which he has valued. But if the valuation officer gives you more than the stamp duty value, whatever considered earlier, in that case we will take SDV only. I repeat, assessing officer referred to valuation officer to valuing the property. If the valuation officer gave a value more than the earlier SDV, then we have to take the SDV only. If the valuation officer gave less than the value of earlier SDV, then we will take such a lesser value which is referred by the valuation officer. Got it? Next, there is a concept of deemed income. If you remember, when I started the topic, I told there are two kinds of two sections which actually speaks about income under the head PGBP. One is section 28, the list of items which we saw. The other is section 41. In section 41(1), what does it say? Recovery of any amount of expenditure already claimed. Let's say, for example, GST expenditure you first showed in your books of account, but later on you got a GST refund. Then that will be considered as income. Waiver of loan by government, it is specifically given as income under section 224. Waiver by trade creditors. Let's say, for example, you are one of the trade creditors waived. Means he told that, okay, boss, you no need to pay me anything. Then in that case, the principal part will be taxable. Interest will not be taxable because 43B gets triggered here. Waiver of capital nature loan will not be taxable because it is in the nature of capital. Balancing charge we have already discussed in the power generation units. 41(3), sale of scientific research assets. See, if you remember, under section 35, you get deduction under section 35 for the purpose of scientific research. If you spend any expenditure, that expenditure, whenever you buy some asset for scientific research, capital assets if you buy, and if you are selling off that asset, in that case how to compute the PGBP is given under this section 41(3). If you have sold the asset without using in the business, in that case PGBP will be lower of sale price under deduction already claimed under section 35. Mind you, here capital gain will also arise if the sale price is exceeding the actual cost. Sir, what if the asset was sold after using the asset in the business? In that case, first you have to add the asset to the block of asset of the business, and the cost you will take is nil. Then upon sale, the provisions of section 60 will apply. Section 50 is nothing but the short-term capital gain provisions. Recovery of bad debts will always be taxable. Next section is maintenance of books of accounts. Who has to maintain books of accounts? Under which section? Section 44AA. There are some notified professions who are required to maintain books of accounts. Maintenance of books of accounts by notified professions. Notified professions are given under this table. You can have a look and just ignore. Professions required to maintain books of accounts. What books of accounts are required to be maintained, and who shall maintain books of accounts? Existing provisions and newly set up provisions. There are two kind of provisions. Existing means it is already in existence. Newly set up means the very new started profession. If in the case of existing provision, if the gross receipts are more than 1,50,000 in all three previous years, boss, in all three preceding previous years, in that case they are required to maintain books of accounts. In case of a newly set up profession, if it is likely to exceed 1,50,000 itself in the first year, in that case they are required to maintain. Even though your gross receipt is less than 1,50,000, you are required to maintain the general books of accounts. Sir, what are the prescribed books? You can have a look. Next, whatever we have seen above is in the case of notified professions. But other than the notified professions, who are those people who are required to maintain books of accounts? Other than the notified professions also, if you are an existing business and if your PGBP is more than 1,20,000 or your sales or gross receipts is more than 10 lakhs in any of the three preceding previous years, you are required to maintain books of accounts. In the case of a newly set up, if it is likely to be exceeding in the first year itself, in that case, books of accounts has to be maintained. Mind you, in the case of individual and HF, a higher limit is given. PGBP, if it is exceeding 2,50,000 and sales or gross receipts uh, less than 25 lakh rupees, then in that case, the individual and HF is required to maintain books of accounts. If you do not maintain books of accounts, in that case, you are levied a penalty of 25,000. The books of accounts has to be maintained for at least 6 years. And if you are offering a tax under the presumptive basis under section 44 AD, ADA or AE, and if you have not offered the minimum income for under those sections, in that case also you are required to maintain books of accounts and pay tax on them. Next section is 44 AD, very very important, tax audit. See, there are three things. One, you are running a profession, or you are doing a business, and in special cases, if you are into profession, in that case, if your gross receipts are more than 50 lakh rupees, if your gross receipts are more than 50 lakh rupees, and if you're doing business, in that case, if your turnover is exceeding 1 crore, mind you, in your business, if all the receipts and payments both, if they are less than or equal to up to 5%, if it is, in that case, the turnover limit is 10 crore rupees. So up to 10 crores, you need not get your books of accounts audited. But if your receipts and payments are more than 5% in other than prescribed modes, in that case, your turnover limit is 1 crore. So if your turnover exceeds 1 crore, you have to get your books of accounts audited. In the special cases like 44AD, 44AD and 44AE, if you are offering income less than the prescribed limits, in that case you have to maintain books of accounts and get them audited. So what if I don't get my books of accounts audited? In that case, you will get a penalty under section 271B, lower of the following: 0.5% of turnover gross receipts and 1,50,000, whichever is lower, will be levied as penalty. Presumptive basis of income for business people, 44AD. See, if you are running a business and if your gross receipts is up to 2 crores, to 2 crores in the financial year or in the previous year, in that case, you are only required to offer minimum 8% or 6% of your gross turnover as a PGBP income. Sir, when 8%, when 6%? 6% on those payments or those sales which you have realized in other than in a prescribed modes. I repeat, 6% on those sales which you realized, means your customers has paid you in through banking channels. On that sale part, you can offer minimum 6%. That is enough. But if you have realized the sales in other than the prescribed modes, means either in cash or a crossed check, bearer check or bearer bank draft, in those cases you have to offer at least 8% of the turnover. Getting it? But if your cash receipts during that year is less than or equal to 5% of the total turnover, in that case, up to 3 crores also you can offer 8% or 6%. Getting it? Next. This is applicable in the case of resident, individual, HF and partnership firm only. This is not applicable in the case of LLPs, companies and all. Okay, got it? Next. Okay. Amount should have been realized before the due date of return of income under section 139(1). Non-allowability of deductions. This is very very important. If you are paying tax, if you are offering your income under section 44 AD, then you are not eligible to deductions under section 30 to 38. Sir, what about the depreciation? Then my asset will not get depreciated. That will be depreciated. WDV of asset has to be calculated considering the notional depreciation. Means for calculating your PGBP income, you will not claim any depreciation under section 32. But in order to reduce the block, you will calculate notional depreciation. Even in case of a firm, salary, interest paid to partners is not deductible. Are you getting this? Are you getting this? Next. Required to maintain a books of accounts. If you are offering minimum 6% or 8%, you are not required to maintain books of accounts. If you are not offering minimum 8% or 6% under section 44AD, then you are required to maintain books of accounts and get them audited also. This is very 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 important point, boss. If let's say for example, if you have opted for section 44AD this year, then for the 5 consecutive years you have to pay minimum 8%, or you have to offer minimum 8% or 6% of your turnover as PGBP income for consecutive 5 years. Let's say, for example, in any one of the years in future, you have not offered income as per section 44AD. In that case, another 5 years you can never opt for a 44AD. Please be mindful. Next, 44 ADA. Whatever we have seen AD is in the case of business, exactly the same way in profession also you can claim a presumptive income. In this case, the limit is 50 lakh rupees. 50 lakh rupees. In business, what limits we had? Turnover of 2 crores and 3 crores. Likewise, here we have a limit of 50 lakhs and 75 lakhs. Generally, it is 50 lakhs. Up to, if your gross receipts are up to 50 lakhs in your profession in the previous year, in that case, straight away 50% you can offer it as PGBP income. But if you have more, if you have less than 5, if you have more than 95% of a realization of a sale of services in a prescribed mode, in that case you can offer up to 75 lakhs under presumptive income. I repeat, if your realization of sale of services means you sold services and whatever money you got from your customers, more than 95% you got in prescribed modes, in that case higher limit of 75 lakhs is applicable. Up to 75 lakh rupees you can offer straight away 50% of your gross receipts or gross turnover, you can offer it as your PGBP income. The same story here also. Resident individual it is applicable, partnership firm it is applicable, but HUF it is not applicable because HUF cannot be in any profession. 50% of gross receipts you will offer. The same deductions under section 30 to 38 is not available. The firm's salary, if any, even in case of a firm, salary interest paid to partners is not deductible. And you are required to maintain books of accounts if you have not offered minimum 50%. Next is section 44A. If you are in the business of plying, hiring of goods carriage vehicles, in that case, if you are owning less than 10 goods vehicle, in that case, you can straight away offer a fixed amount. What is the fixed amount, sir? For heavy good vehicle, whatever you have, rupees 1000 per ton of gross vehicle weight. You have to take the gross vehicle weight and then divide by 1000 you will do for each month or part of the month for each vehicle. And for other vehicles means lighter good vehicle, in that case 7500 for each vehicle for each month you have to pay, you have to offer as a PGBP. And here also section 30 to 38 they will not allow any kind of deductions, but in case of a firm, partners remuneration, salary and interest are deductible under section 40B here. In case of 44AD, in case of 44ADA, whatever firm makes payment to partner in the form of remuneration interest was not allowed, but here it is allowed. Requirement of maintenance of books of accounts. If you are not offering this 10,000 per ton or 7,500 for each vehicle, in that case you have to maintain books of accounts. What is the heavy good vehicle and the gross laden weight, everything is given here. So this ends our discussion on PGBP, boss. Thank you so much.